From one tech company to another, Bumble set to report earnings after the bell as shares of BMBL touched a new 52-week low before jumping into positive territory. There you're seeing shares up on the day, holding on to gains as of right now, but you're also seeing a look at the longer term. Since they've gone public, down 75%. Evercore ISI maintains an outperform rating on Bumble, and Shweta Khajuria, Director of Internet Equity Research at Evercore ISI, joins us now. Shweta, great to have you here with us today. Help us break this down a little bit further going into the earnings after the close. For businesses that were talking about pent-up demand, Bumble was certainly hoping that restrictions as they started to lift, not only would its platform see growth, but paid user growth especially. So to what extent do you believe that the Omicron variant will actually show up in Bumble's average revenue per user results for this most recent quarter?
Well, there are two. So Bumble has two levers. As we saw last quarter, the stock traded off meaningfully after they printed and held their earnings call post the third quarter. All eyes are on both things, on payer growth as well as the revenue per payer growth. But investors, as we saw last quarter, care more about the payer growth. Our intra-quarter data points based on app downloads and app engagement, monthly active users, and revenue intra-quarter data points show that fourth quarter actually held up fairly well. So overall, the expectation is for fourth quarter payers to come in, or net additions in payers to come in higher than that in the third quarter. Now, in terms of revenue per payer, it is slightly unclear because that changes quarter to quarter, depending on several variables, and management actually manages to total revenue and balances the balance between payers and revenue per payer. So while we think that revenue per payer should grow in the fourth quarter as well, all eyes will be on the payer number for the fourth quarter, and most importantly, for the full year guidance. Now, before we get for the full year, I don't think that management will guide to a payer number or a revenue per payer number, but there is some expectation for management to comment on whether net additions for the full year across payers will be greater this year compared to last.
That's really interesting. Okay, we'll stay tuned for that on the call, of course. In your note, you also acknowledge that the Russia-Ukraine war even has an impact on Bumble, given their exposure to the region with Badoo. Is there a net effect that you're anticipating this to have on Bumble's outlook?
Yeah, well, majority of the impact is expected from Badoo. We think that at a high level, at a parent company level, the impact is likely going to be low to mid single digit percentage of their business. So call it 4 or 5% of their overall business, which includes the impact from Badoo plus some from Bumble. At a high level, we think that about low teens to mid teens percentage of the app downloads or users are coming from Russia and Ukraine region. But because revenue per payer in those regions is meaningfully lower than what we see at Bumble or even the average at Badoo, the revenue impact is, call it, low to mid single digit percentage of their business, and that's the expectation. So the impact in the full year guide will be dependent on whether they're going to continue to run their operations in those countries, and if they decide to not, then the downside is that 5% of their business could see meaningful headwinds.
And then just additionally here on Bumble, of course, the recent acquisition of Fruits, that's certainly going to get some questions on the call. What type of contribution do you forecast the Fruits acquisition to provide to Bumble?
It is unclear. I mean, they didn't disclose much, but to us, based on industry conversations that we've had, it seems like it's a tuck-in. So probably not a meaningful contributor to their revenue, to the parent company, but I think it helps them get into France and Western Europe a little bit faster than it's just the build versus buy, and they went with the buy with Fruit. So in terms of expanding into Western Europe and competing against, call it a Tinder or a Hinge in those markets, they will accelerate their path to market penetration there.
Just lastly, while we have you, I know you also cover Peloton. Got to ask about the expanded trial period, 30 days to 100 days now. Do you believe that is going to be a net positive for the retention and the number of people that buy a device, a connected device, and decide to keep it after that period?
I think so. Well, we can look at it on two ways. First is they're extending that period, and the reason why they may be the intention behind why they may be extending it. So that, to me, could be a negative sign as to maybe they need these folks to keep that equipment. On the positive side, yes, if I keep my treadmill for instead of 30 days, 120 days, I've used it enough, I've gotten used to it, and I've less of a likelihood that I'm going to return. So it could potentially impact their retention rates. The other thing on Peloton also is that they're running a brief promotion in terms of, I think, up to $300. That, to me, also implies incrementally negative for Peloton. They wouldn't be running this promotion if they were selling equipment fairly easily. So these, to me, are incrementally potentially negative on where the consumer demand is for connected fitness right now.
All right, really continuous tracking that we've got to do with Peloton as of right now.
Yeah.
Shweta Khajuria, who is the Director of Internet Equity Research, Evercore ISI, joining us here today. Shweta, appreciate the time.